Welcome to the MUFG Global Markets Podcast. I'm Jonathan Wong, and today I'm joined by George Goncalves, MUFG's head of U.S. macro strategy. It's Tuesday, February 11th, 2025. Well, welcome back to the podcast, George.
Good to be back, Jonathan.
George, let's start by recapping a little bit of last week. So we got the important labor data, and in your view, what was the key takeaways from this employment report?
Yeah, I think it's a good place to start doing a quick recap, although I think many of us have overanalyzed this data, and it really now at least puts a new kind of baseline of where things are with the revisions, the birth-death model, a lot of population adjustments. I think there was a little bit of everything for everybody, both some stronger than expected outcomes on the near-term data with the 3-month average being a little bit higher, although the headline for January was weaker. We did get revisions to the back months, but the big ones were the benchmark revisions, which was not as negative as it was initially back in August. But at the same time, you had the birth-death model swing in the opposite direction. It historically has been skewed to being a better outcome each time it gets revised, but this time it was negative, which I think at least kind of proves the theory that we've been saying for quite some time, that the birth-death has been overestimating the actual true health of the labor market. And then just really big revisions as population data sets from the CPS were included. A little bit of everything from everybody to kind of contemplate what it means at this point going forward. At a minimum, we have it behind us. It's good enough data to at least keep the Fed from having to cut. And so I think that's what matters most for the bond market. And we had slight backup in rates. But I think from this point forward, it's going to be interesting to see the birth-death model adjustments on a go-forward basis. Will the reduction in immigration potentially lead to less overall headline growth in jobs? Will the reduced amount of government job growth do the same? And will that result in a weaker, at least even optically weaker jobs data on a go-forward basis? I think that at a minimum, it's clear to err on a number of things, and now we have a new baseline.
Moving on, with the recent announcement of aluminum and steel tariffs, the focus has shifted towards inflation once again. What are you looking for in terms of January's CPI this week, and what are the upside and downside risks to that view? Should we be worried about potentially higher inflation over the course of this year?
Yeah, I think we kind of did this last time in our last podcast. All throughout this year, we're going to have to compartmentalize short-term versus medium-term and long-term implications to a whole host of macro factors. And when it comes to inflation, there's inflation expectations, and both from the consumer side, general sentiment in the economy about inflation and what the markets are pricing in versus the reality on the ground, and really distinguishing between price level adjustments versus the growth of prices or the inflation rate. And then we'll get to the January CPI and our expectations in a second. The tariffs have been serving as a constant reminder that people are concerned about inflation. If you look at the 10-year break evens, they've had a pretty big move both after the Fed started cutting rates in September and normalized by 100, and also post-election. But what's really been fascinating, if you take an even more zoomed in look, inflation break evens, heading into the CPI report, break evens have been widening again. They're back to close to the widest levels on the 10-year break even as it was at the beginning of the year. But the key difference is that real rates have rallied while break evens have widened. So that's a real kind of signal around inflation concerns, inflation expectations widening, and also kind of a slower growth environment, all else equal. So that's what's really different. In the beginning of the year, we had real rates at the local highs in rates, as well as wide break evens. This time we have similar levels in break evens, but yet real rates have been rallying, kind of emphasizing this concern around this stagflation-like kind of environment risks. Looking more closely for the upcoming report, I mean, we don't think there's going to be a lot in this January report. At the start of the year, there's going to be the standard reweighting and shifting around of importance on like which categories have greater weight. We don't know how that's going to shake out, but that could have a impact on a go forward basis. So we'll be watching the weights for the different CPI baskets. And then on the actual number, I mean, it's almost kind of like a draw. The expectations, according to Bloomberg, is at zero point 0.3 for both headline and as well as core. There's probably some upside risks more for headline, given the temperature and the weather and just higher energy prices over the course of January might have some bias towards higher headline. So there's a risk that we get a higher than zero point 0.3. But the real focus on the core side is going to be looking at will we get a continuation of the downside risks, which we've been flagging, or the improvement in inflation, which should come from owner's equivalent rent. Chair Powell and a number of other Fed speakers have been emphasizing we should be looking at market-based kind of core measures of inflation, not imputed by models. And I agree with that. I think we all agree with that. And so if we see a owner's equivalent rent decline that's consistent with what we're seeing from actual market-based type of inflation, the market will be okay with that. And if it's something that's really out of the norm, I think it depends on the magnitude. So I think that plus transportation costs have been something that's also been a kind of a thorn on the side of prices, and it's been also hard to kind of factor in. So hopefully it's a non-event, and then we'll move on to what lies ahead for the rest of the month.
And just as you mentioned, looking ahead post CPI, is there anything else on your radar for the balance of the week in terms of potential market catalysts?
So there's always the unknowns that we might get some new updates out of Washington, which just new kind of policy prescriptions, and or the tariff risks are always looming out there. But besides the things that are hard to forecast, we're just kind of watching closely about how the conversation around the budgets and the debt ceiling, and just thinking about, I mean, even though it's kind of early, but at some point, we're going to have to start to think about and just kind of government financing and these short-term fixes to kind of hold us over. And do we get a grand deal, or do we get a more kind of piecemeal individual components of what's necessary to keep the government open, as through continuing resolution and the debt ceiling itself. So yeah, I think the shift, once we get past inflation, the focus will really turn towards DC budget process, I think.
Thanks again, George, for all that.
Thank you, Jonathan.
We would like to remind our listeners, for those that would like to receive George's strategy reports directly, please email your MUFG sales coverage or get in contact with George directly on email or Bloomberg. Thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.